What's up, everyone? Welcome to another Market Radar podcast. Hope you've had a great week. The NASDAQ is not doing too good. Most of the week since Tuesday has been red every single day, but it remains bullish trend. So keep that in mind. We do not short bullish trends. The NASDAQ can go down to 14,000 and still remain bullish trend. So keep that in mind. We do say that we don't short bullish trends, but also the regimes must align. If you're a member, you know what regime we're in. We play accordingly. Now, a big part of this week was CPI. CPI did come in under estimates, and bonds continued lower. As you can see, ZB has continued lower. We're almost down to the lows of peak hysteria back in November when the inflation uncertainty was at a peak. We didn't know how high inflation was going to go. We didn't know how high the Fed was going to raise rates. We're back at those levels once again. So why are we here? What is causing this to be at peak hysteria levels once again? We know inflation is down, came in at 3.2%. What is causing this? Is inflation uncertainty coming back? Is it because the market is starting to believe that the Fed is going to be higher for longer, even longer than what was expected? Or are bonds expecting more credit downgrades? What is causing this?
So I do think that inflation rate risk overall remains rather controlled. I do also think that the reason for higher rates are more isolated on the longer end of the yield curve. Now, what I mean by that is duration risk, right? So as you go out further in the yield curve, there's more duration risk, and therefore yields on the long end of the curve have risen more than the front end of the curve, which again, primarily duration driven in this recent rate move. And prior to what we were seeing when rates were going up so drastically was due to the Fed lifting the front end so egregiously. That was basically front end rate, short term interest rate control. This is now we're starting to see the back end progressively lift higher.
And so
It's not,
what's causing that? Is that because the market is starting to believe that the Fed is going to keep rates higher for much longer than they originally thought?
yeah, that's a partial driving factor, but I think we also have to understand that, especially those that are getting all freaked out about the progressively the progressive move higher in rates on the long end specifically, that the long end is mainly supply and demand driven, right? Like it's not so much isolated to where the Fed is moving rates today because you have so much time in between now and for example, look at a 30-year bond. You have 30 years of time from now. The Fed is obviously not going to be consistent in terms of their policy over the next 30 years in terms of like holding policy at a certain rate. So there's more dynamic there. There's more ability for push and pull between supply and demand. And also, there's lower liquidity the further you go out in the curve. And that's because obviously, as I just said, when you go out in the curve, you increase this duration risk, right? Money's always going to go to where it's safest in terms of size. If you could think about like someone that has a checking account that just wants to collect interest but doesn't want to risk their money, they're going to put it in basically a money market fund. They're not going to take duration risk and buy a 30-year treasury, right? Because then they have to lock their money for 30 years essentially. Where a 1 month money market fund or 1 month T-bill, they could get their money back or sell it, minimal loss, get their money back in less than or 30 days. And that's the difference. Now, I bring up supply and demand because it's a main driver on the long end of the curve. And as we were talking about this specifically in terms of supply, um, a few months ago, we were basically telling everyone that the TGA rebuild was and is still going to mostly be driven by bill issuances, which again is not a duration risk amplifier, right? You're not basically putting pressure on the duration part of the Treasury curve.
Wait, so can you explain what the TGA is real quick for those that don't know?
So the TJ is basically the Treasury's checking account. And what that is the account at which the government pays its bills from. Now, the TGA is refilled usually in two different processes, right? You have Treasury bond and note or bill issuances, basically Treasury security issuances, and taxes. So the what was seen as being an issue earlier this year was after the debt ceiling was hit and then suspended thereafter, the Treasury was looking to raise a sizable amount of money. And they were looking to raise most of this money, obviously, via the security issuances, bonds, bills, and notes. They did this primarily in by raising money in the bills section. Now, what that does is it reduces the duration risk as we spoke about earlier. Remember, there wasn't a lot of pressure on duration. They were doing a lot of this, as you can see, new money, meaning new money that has to come in to the treasury account that doesn't already exist in the bond market via maturing securities, and so on, was $829 billion. This was bills, right? New money. Now they were looking to issue a new money. Now we had only 177 or 178 billion. So we have 829 billion new money in bills and 178 billion roughly in coupons, which this is pretty much the duration aspect of the bond market. So as you can see, there wasn't so much pressure on that duration side of things when the Treasury was raising that initial the initial call it war chest of supply that they needed in the TGA. It came basically from the short end of the curve, and the short end of the curve is able to pull money out of the reverse repo market, which is why we saw the reverse repo market drawdown quite a bit, and that was basically funding this demand. Now, the reason I bring this up is we now have the schedule for Q4. This is Q3 going out to September 29th. Q4 came out and things are a little bit different. As you can see right off the top, there is only $500 billion being pulled into the Treasury market from new money on bills, whereas there is now roughly $339 billion being pulled in from duration or coupons. So what ended up happening here is obviously the Treasury is raising less or expected to raise less this quarter than they did last quarter, roughly 20% less. But they're doing 90% more of the raising in coupons. So they're adding pretty much more pressure on the duration side of things. Now, obviously, the market doesn't know how long or how far out this type of action, or I should say, this type of issuance directive is going to go, right? Because we can't see into the future. Like we don't really know how they're going to do it, what they're going to do in Q1 of 2024, and there is some risk there. If the Treasury starts adding more and more weight for whatever reason on coupons or duration risk assets, they are going to slowly chip away at the market in terms of supply, and that's going to have to raise rates to entice more people in. The good thing is, though, the long end of the curve remains ample in terms of the ability, in terms of demand for this supply. We're talking about people showing up to auctions with total amounts exceeding available supply by over 2x, meaning there's double the amount of money at these auctions looking to get filled that aren't getting filled just yet. But obviously, if we just keep issuing more and more securities in the long end, we're going to chip away at that I want to say demand of individual or demand of money looking to get filled. We would chip away at that, and that's something that we have to pay attention to, or in the bond market is paying attention to, right? Because now you might say, well, inflation, this could be driven by inflation. Well, let's take a look at just the 5-year break-evens, for example. We like to use them because they're in the middle, right? They're not too far out to where they don't move. Because remember, the further you go out on break-evens, the flatter they become, because the idea is the Fed will control inflation expectations over the long term. So the 5-year gives us a little bit of both sides of the equation there. Not too short, not too long. And you can see we are up off the lows, but we're not up that much, right? Remember, let's overlay the 5-year, for example, here, right?
Well, so this is telling us that the move in ZB futures is not caused by inflation uncertainty, but mostly from this TGA activity?
Mostly, yes. And what we can do is we can take a look here at rates and real yields, right? So, excuse me, real yields between the nominal rates and the break-even rates. What I mean by that is, look, the orange is the Treasury yield that everyone's looking at, 10 years almost at cycle highs, right? And we're talking like you were just saying on ZB, we're almost at that peak hysteria level. But inflation is well below the peak hysteria level, right? Last time this rate really excelled higher, break evens already started breaking away from their highs and they were already leading lower, signaling that maybe inflation is the issue here. And bond yields quickly sold off after realizing that inflation was no longer a main macro driver in terms of it being excessive and unpredictable. On the other hand, now we're back up here again, yet break evens aren't. So the question we have to ask is, are yields leading the move in break even rates? Or is this really not so much driven on inflation and more, we just had a credit downgrade, even though it's minimal. And like you said, the Treasury, or like I explained and you just mentioned, the Treasury is starting to issue more duration. Both of those things will weigh on long-term yields. And the way we can basically put all of this together in an easy to understand graph is by looking at the difference between a 30-year and 3-month yield. Complete opposite sides of the spectrum. You have bills and you have bonds, and you're just comparing both of them, right? And you can notice here that we've slowly lifted up off the lows. And what's going on here is the 3-month really isn't moving anywhere. We're pretty much stuck. But the long end is moving, and what's happening is the long end is slowly rising, lifting this curve because we're taking the 3-month from the 30-year. So if the 30-year starts going up, it'll reduce the negative difference between the two. And this is what some would consider the beginning of a yield curve reversion, right? Because you have the spread slowly climbing towards zero. The
Right, but
problem here,
it's a reversion the opposite way.
right. And that's not something that I think is going to be sustainable. And what I think is going on is the long end of the curve is repricing for, again, the possibility of a supply surge due to the Treasury. There's going to be some risk premium. The bond market is one of the biggest equity, or the biggest, not equity, the biggest security markets out there, right? We're talking about almost roughly in the high 25, $30 trillion range. So it's going to take risk accordingly. If there's a possible credit downgrade, fiscal irresponsibility, and a potential possibility of supply surge on the long end, it's going to start repricing, even if it's slowly, right? It's not to say that inflation is going to rip roar from here. We can't make that assumption yet. I mean, we can just look at something like commodities, right? Commodities, they're failing at the moment to break trend higher. This is going to be a key moment here in the inflation in the inflation wave. Commodities will have to flip trend for it
Right.
to be for us to even start thinking about a sustained move higher in inflation. We've been so clear about this entire time. Inflation will not go from 9 or 10% down to zero. It won't. Or even 2%. There's going to be some bumps and hiccups along the way. And we've seen that. And we will continue to see that. It doesn't mean that inflation is going back up to 9%, or some of these late 70s, early 80s guys are telling us inflation is going to go to 15% from here. That's not the way to look at this. You have to take it day by day, right? So as long as we're in a bearish trend in commodities, you can't really get too excited about inflation. You just can't, because commodities are a main driver in inflation. So they're easy to see, they're easy to chart, they're easy to watch. Bearish trend, not so much inflation risk. Once this goes bullish trend, we will start to say, you know what? Inflation may have some sort of risk in the future here. But again, we spoke about this last week. Not only is it the bullish or bearish trends that matter here, it's the speed at which commodities operate in either of those trends, right? If we're in a bullish trend and we're going up really, really slow, it's going to have a less of an impact of inflation in comparison to where we're in a bullish trend and we're ripping, 10% a month, which is what we saw over here. So this is very important. You have to pay attention to this. Don't just be gung-ho all in inflation for no reason, or no supporting base fundamental. You could call
I
it
think a lot of
fundamental.
people are just confused right now because they're seeing yields ripping, and they automatically assume that that's inflation related. So I think that's where a lot of confusion lies right now is everyone is expecting inflation to rise again just because of what bonds are doing, and they're not able to read bonds properly on what they're actually
Right.
telling us. But
Right. And
so
it's
what does this mean for equities? How does this
oh,
affect
that's
equities?
okay. So yeah, that's good. So let's take this into equities because obviously higher rates, everyone's concerned about a higher risk premium in equity or excuse me, a negative impact to risk premium in equities. And I can tell you this much. The higher the rates are, the higher the long end is going to at some point have some sort of impact in equities. The question is how bad and to what degree. And again, this comes back to where and why the long end is rising. If the long end is rising just out of speculation of supply issues, excuse me, and credit fears, and that somewhat gets resolved, then there really isn't a reason for them to rise outside of the fact that the Fed may hold higher for longer. And um, this all goes back into the ability for the Fed to manage the soft landing, right? Because higher rates theoretically aren't the worst for equities, but it's when the rates are going higher and growth is slowing. That's pretty much your growth's already slowing, you're adding more restrictiveness to the economy. It's different when rates and inflation are going higher, but growth is sustained. That's what we call an inflationary regime, right? But if growth is fading and inflation is fading as well, which it has been, but rates are higher, it's giving you a signal that the Fed is becoming more and more restrictive with their policy, and the bond market is therefore extrapolating that out the curve. Again, we do have that issue out on the long end. We do have the credit downgrade, but the Fed is also talking. They're very clear about not cutting interest rates. Now, the Fed funds futures market is expecting the Fed to cut rates in 2024. But the long end doesn't seem to really care about that right now. There seems to be some sort of issue out there. The long end should be, as rate cuts are being expected to pick up in the market, the long end should start getting a bid. It's not. This is what I'm telling. This is why I say it's more than just inflation in the Fed. There's some other factors, and I would probably say that the credit downgrade plus supply thing is weighing a little bit too much on the long end right now. But in terms of equities, as that long end moves around, it's going to affect equities. But we're going to need to see that growth situation really start to degrade. I'm talking about excessively to really bring equities down because, like I said earlier, if growth does maintain a positive and decent trajectory, as long as that happens, rates can go higher and companies can outgrow to a degree that shift in interest rates. It's when growth starts falling apart that things really start hitting the fan and the Fed remains too restrictive. Again, them managing this whole soft landing, right? For the Fed to land the soft landing, they have to manage their policy lags correctly. We saw literally the fastest rate hiking cycle in modern history, okay? And the Federal Reserve is telling you that a recession may be off the books at this point. And they're also telling you that inflation is a problem and they're going to have to be persistent with it. Well, that's the wrong answer. If a recession is off the books, it means that we've already taken inflation down. You should look at easing financial conditions to a degree slowly or start thinking about it. And you should start thinking about how you're going to choke out inflation without overdoing it. Meaning, as inflation falls, break evens will go down, right? Because inflation expectations will drop. But if the Fed remains restrictive, nominals will stay up to a degree, expanding real yields. Real yields are the difference between these two. And expanding real yields are a restricting force on the economy. So essentially, the Federal Reserve just holding rates where they are, and if inflation were to fall, the restrictiveness on the economy would just compound on itself and get bigger and bigger and bigger. And that would end up actually over restricting the economy. And if the Fed is going to hold rates, which they most likely are at some, maybe we get one more rate hike depending on, it doesn't look likely at the moment, but we'll see what happens. It looks like we're going to just hold here. And if we do, and inflation starts falling, the Fed has to be very decisive on when they say, you know what, inflation isn't a problem anymore. We need to start reducing rates. And it doesn't seem like they're going to do that. Everything's about inflation so problematic. Inflation, everything's so negative still about inflation. Inflation's at 3%, but they're still so gung ho about killing it And this is probably where the issue is going to arise, which prevents them from actually achieving the soft landing, because they're going to end up over restricting the economy for too long. And then, therefore, by the time that they see what's going on based on their data points, which again are lagging, and they're so focused on employment, which again is the worst or the most lagging indicator in the economy, by the time they see the effects of policy today in those data points and they start to lower rates, then it will already be too late. And that's why it's very hard or nearly pretty much impossible for them to achieve the soft landing, because by the time they recognize the soft landing as achieved, it would be stale data, and we'd already be on the way to the hard landing. So they
Right.
pretty much are screwed from the jump because of the way that they're structured and the way that they operate. So if we look at how this will affect the stock market, because obviously we're all here to make money. The question is, that lag in policy that the Fed that I just spoke about, how long that lasts will be a driving factor in, even if interest rates can come up. Yes, there will be a negative effect on equities. But if that window is large enough, the rise in interest rates won't be as detrimental if growth can be sustained for a period of time, which means equities can go higher than you might think, before those lags start fully bleeding into the economy. And I should say, through the economy. They're already bleeding into the economy, right? As they cycle through the economy. And once they get through the economy, it's most likely at that point that you're going to see the recession. Unfortunately, most of the people that are cheering or claiming the recession is going to happen will not be here by the time we get there.
Right.
And
It's possible that equities could even be at new all-time highs when that happens.
100%, it's possible. I don't want to. I shouldn't say that. 100% is possible, right? Stupid, right?
Yeah.
Of course, it's possible. Of
Yeah,
course,
it's possible. It's not guaranteed, but it's important to understand that a recession never happens when everybody and their mom is expecting a recession, which is, we're not quite at that point anymore, but we were just a couple of months ago. We still have a ton of people saying, "Oh yeah, recession's coming." Like it's obvious. End of
Yeah,
this
this is the
year,
bull market rally,
start
or
of
bear
next
market
year.
rally,
Yeah, this is just a bull market rally. Start of
bear
next
bear
year.
market, bear market, bear
Yeah,
market.
bear market rally. Start
Right,
of
right.
next year, there's a recession. People are just so confirmed on that idea. But are they still going to be confirmed in that idea once NASDAQ hits all-time high? Probably not. And
Yeah,
that's when shit's really going to start hitting the fan. And yeah, likely that'll happen when these effects from these policies over the past year, the highest hiking cycle in history, the strongest hiking cycle in history, starts taking effect in unemployment. And then to reach those worst case scenario levels that we got back in December of 2022, those levels. So we reached those levels when we were at peak inflation uncertainty, we were at peak interest rate uncertainty. We didn't know how high the Fed was going to have to raise rates. Now, to get back down there, I feel like we're past the inflation hump. Obviously, if we get another spike in inflation like in the 70s, then we'd be back there again if we get inflation uncertainty again. But I think we might actually, if we do get down there, it will be because growth is uncertain at that point. So
yeah,
growth
yeah.
would collapse to the point where people don't know what's going to happen. The Fed cuts rates, growth keeps dropping, and there's going to be the growth uncertainty rather than the inflation uncertainty. I think that's what it would take for equities to really get back down to those levels.
Right, and that typically would come with the unemployment drive, right? We'd start to see the unemployment rate pick up excessively, as again, that will have a direct impact on growth, right? You're having the labor force basically be neutralized, and I do think that we can monitor the labor force in a certain way, which we've actually heard Powell speak about this to a degree, measuring job openings for every unemployed person. Right? I have that chart right here. So what this measures is the number of jobs on the market for every person that's unemployed. We're at 1.64, meaning there's 1.64 jobs for every single unemployed person. The problem is, in terms for these recessionists and with these hardcore bear guys is outside of COVID going back 20 years, we haven't had the other two recessions did not happen when, and again, our job opening data only goes back to 2001. Otherwise, we could measure this ratio back further. But job openings, I believe, only started beginning to be reported in 2001. So, long story short, we go back to 2001. That's all we could see. We could see three recessions. COVID, we hit at 1.23, meaning COVID hit when there were 1.23 available jobs for every unemployed person. Now, argument can be made very easily that the governments locked their countries down and it wasn't a real recession in terms of how it was formulated. It wasn't an actual economics, like start to finish slowdown caused naturally. It was basically man-made. Now every recession is man-made, right? But like it was in basically a forced recession. Historically, we start to see recessions form when the ratio is well under 1. So what this is telling you is there should be, for a real recession to happen, there has to be more unemployed individuals per job opening. We have to be under 1, meaning there has to be basically less job openings than there are unemployed people. So we can basically infer and take a step back and say if we have the unemployed, the job openings right now are about 9 point something million job openings. And we're looking at about 5 million unemployed people. So I would argue that we would start to see the recessionary odds accelerate if those two met in the middle somewhere. I'm not saying job openings have to go from 9 to 5 or unemployment has to go from 5 to 9. I think maybe unemployment going up from 5 million people to 7 million people or job openings coming from 9 to 7 would start to be the real signal that, you know what, things are breaking. Until that happens, the soft landing is still in effect. Do not fade it. It will continue. Consensus is not max bear yet. You can tell. I mean, max bull, excuse me. Consensus is not max bull. There are bears everywhere. There are always bears. There's perma bears, right? But there are really bears everywhere. Turn on your TV. Everyone's wondering. Banana peel, they said today on Bloomberg, we're a banana peel away from a recession. A banana peel slip, whatever the hell that guy said. Literally.
Yeah.
Right?
So many people are still certain that a recession is coming. And that alone means it's not coming yet.
Right. And back to what you were saying earlier about equities, the way the unemployment market acts towards the next economic slowdown, which again, remember, the economy's expand and contract, and it's normal. The economy will slow at some point, and how unemployment reacts during that period will be the main driver. Obviously, they're both, unemployment's correlated to growth, will be the main driver in how growth is interpreted there in the market. So how hard of a sell-off are we going to get? How deep will it be? Well, one thing is certain. The lags have to expire or pretty much mainly cycle through the economy before we can get there. And we just aren't there yet. We're literally last year at this time, the Fed funds rate, I believe, we can pull it up right here. Let's go back in time. So last year in August of 2022, the Fed funds rate was 2.3%. We're up 300 basis points in 1 year. The move here is insane. We've done 300 basis points of hiking in under 12 months. Meaning the average federal funds rate has not been over 5% for a very long time. Meaning there is not much. We haven't been in a real restrictive policy state for that long. We are restrictive now. The federal funds rate is higher than the rate of inflation, higher rate of PCE, higher than the inflation expectations, meaning we're in positive restrictive territory, but we haven't been there for that long. Meaning the effects of this restrictive state have not been able to cycle through the economy just yet. So you can't just say, oh, the Fed hiked 500 basis points, they're going to break something. They will, but it's a matter of not, are they going to break something tomorrow? It's how long will it take for them to break something, just holding rates where they are. The most powerful tool the Fed has is not the spot rate that you see here. It's the ability to sit there and sit on those rates indefinitely. That's where over time, as inflation slows, again, they're restrictive enough to cure inflation at this point. And in the 80s or the 70s, what they did was they cut too quickly. That's what happened. And if the Fed just holds, they will cure inflation at these levels, but they will also incite a recession in the process. The question is, will they be smart or quick enough to differentiate when they've got inflation into a tameable territory and start to reduce the Fed funds rate without having to drop it dramatically due to an excessive recession? That is such a dynamic problem. I do not think the Federal Reserve will be able to handle properly, which is why I tell you the soft landing is mostly pretty much impossible. But it's going to take a while for the hard landing to come to fruition. So you have to be able to manage the risk in between. We could, in fact, have a positive stock market for a while. Could be for a while. Could be for 6 months. Could be for a year. I can't tell you the duration, but I can tell you that there's certainly a large amount of pent up lag here that has to cycle through. And what happens in the interim is basically up to how you can manage risk. If the market does, like you said already, if the market goes to all-time highs and the regime flips favorable in that manner, will you be able to take advantage of it, or will you be too scared because you think the recession is going to happen tomorrow? And if your answer is, I can't long equities here because a recession is going to happen tomorrow, most likely a lot of people are thinking the same thing, which if the market does start to lift again, you're going to have that consensual opinion of, you know what, not a good time to buy. The recession's coming tomorrow. The recession never comes. And then you get everyone piling back in at all-time highs, just like the retail guys do. They buy the highs, the hard landing comes. I'm not saying the hard landing is going to happen exactly at the highs, but you get my point. They buy equities at or near their peak, and then they end up puking at the lows. That's how the cycle works. That's why retail is terrible at managing their own money, because they're very emotional. They want to get in when the getting in is good, and they want to dump when the times are bad. They don't want to do the opposite. And that's pretty much, you need to do the opposite of that to be successful in the stock market. So that's, I think, where we can leave this podcast off for this week. If you guys have any questions, feel free to reach out to us on our Twitter at The Market Radar. You can also get access to our Radar membership on our website at market-radar.com. Thank you.